Here's something strange. Most people who build real wealth never had a high income, never picked a winning stock, and never got a lucky break. They just did a handful of boring things over and over for a very long time. That's it. That's the whole secret. And today we're breaking down 7 of those habits in plain language with real numbers so you can see exactly why they work. Before we go further, quick note. This video is for general education, not financial advice. Everyone's situation is different, so treat this as a starting framework, not a personal recommendation. Habit number 1 is paying yourself first. Most people do it backwards. Paycheck comes in, bills get paid, groceries get bought, a little fun money gets spent, and whatever happens to be left over at the end of the month gets saved. For most people, that leftover number is 0. Paying yourself first flips the order. The moment your paycheck lands, a fixed amount moves automatically into savings or investments before you ever see it or get the chance to spend it. Even something as small as $100 a month moved automatically tends to survive far longer than a plan that depends on willpower. The habit isn't really about the amount. It's about removing the decision. You can't accidentally spend money that already left your checking account. Think about the math over time. $100 a month is $1,200 a year. Over 20 years, that's $24,000 in contributions alone, before any growth. Bump it to $300 a month, and you're looking at $72,000 in contributions over the same 20 years. The exact number matters less than the fact that it happens automatically every single month, regardless of how busy or broke that particular month felt. Habit number 2 is fighting lifestyle creep. This is the quiet one because it doesn't feel like a mistake while it's happening. You get a raise, and almost immediately your rent goes up, your car gets nicer, your subscriptions multiply. Say you get a $5,000 raise. If your spending rises by $5,000 too, your savings rate never moves, no matter how many raises you get over a career. The people who build wealth quietly do something specific here. When their income goes up, they let their savings rate go up faster than their spending. A common version of this is banking half of every raise and only spending the other half. Do that for 10 years across a few raises, and the gap between you and someone who spent every dollar becomes enormous, even if you both started at the same salary. Habit number 3 is capturing the full employer match, if one is available. This is one of the few places in personal finance that behaves like free money. Say your employer matches 50% of what you contribute to a retirement account, up to 6% of your salary. On a $60,000 salary, that means contributing $3,600 gets you an extra $1,800 from your employer, deposited automatically. That's an instant 50% return before the money is even invested in anything. Skipping that match isn't a neutral choice. It's turning down a raise you already qualified for. Play that forward. $1,800 a year in free employer money, contributed consistently for 20 years, and left to grow, can realistically turn into well over $100,000 by the time it's needed, depending on how it's invested and how the market performs over that stretch. Nobody hands you $1,800 a year for free very often in life. A retirement match is one of the rare times someone actually does. Habit number 4 is building a real emergency fund and actually leaving it alone. The common recommendation is 3 to 6 months of essential expenses, sitting somewhere boring and accessible, like a high-yield savings account, not invested in the stock market. Here's why this matters more than people think. Without that cushion, a single surprise, a car repair, a medical bill, a layoff forces you onto a credit card at 20% interest or worse. That single event can undo years of otherwise good decisions. The emergency fund isn't there to make you money. It's there so one bad month doesn't turn into 3 bad years of digging out of debt. Put a number on it. If your essential monthly expenses, rent, groceries, insurance, minimum debt payments, add up to $3,000, a full emergency fund is somewhere between $9,000 and $18,000. That can sound intimidating if you're starting from zero, which is exactly why most people build it in stages. A starter goal of $1,000, enough to cover a typical car repair or a broken appliance, is a reasonable first milestone before working toward the full 3 to 6 month cushion. Habit number 5 is choosing low-cost, broadly diversified investments over trying to pick winners. This is where myth and reality really diverge. The myth is that building wealth in the market requires finding the next big stock before everyone else does. The reality, backed by decades of data, is that the vast majority of professional fund managers, people who do this full-time with research teams, fail to beat a simple low-cost index fund over any given 10-year period. A fund that tracks the overall market with fees under 0.5% a year has historically outperformed most actively managed alternatives once you account for their higher fees and higher taxes from frequent trading. This doesn't mean investing is guaranteed or risk-free. Markets go down, sometimes sharply, and past performance never guarantees future results. But the habit of consistently investing in something broad and low cost and not trying to time the market has quietly outperformed a lot of flashier strategies. Here's the myth versus reality side by side. Myth: you need to find the next big company before the crowd does to really build wealth. Reality: most people who try that underperform a simple index fund over the long run and pay more in fees and taxes for the privilege. Myth: fees don't matter much if the fund is good. Reality: a 1% annual fee sounds tiny, but compounded over 30 years, it can quietly consume a fifth or more of what your account would otherwise be worth. Habit number 6 is attacking high-interest debt before anything else. Not all debt behaves the same way. A mortgage at 6% and a credit card at 24% are not the same problem. If you're paying 24% interest on a balance, that debt is growing faster than almost any investment could reasonably be expected to grow. Paying off a credit card at 24% interest is, in effect, a guaranteed 24% return, which is a better deal than almost anything available in the market. So the order matters. High interest debt first, then the emergency fund, then longer-term investing. Getting that order backwards is one of the most common and most expensive mistakes people make. Picture a $5,000 credit card balance at 24% interest with only minimum payments being made. That balance can take well over a decade to pay off and cost thousands of dollars in interest on top of the original $5,000, simply from letting it sit. The same $5,000, redirected toward aggressively paying down that balance instead of trickling into a brokerage account, usually leaves people better off, because guaranteed interest savings at 24% beat uncertain market returns almost every time. Habit number 7 is checking net worth instead of checking the stock ticker. Watching daily price movements creates anxiety and encourages impulsive decisions, like selling during a dip out of fear. Checking your net worth, total assets minus total debts, once a month or once a quarter, tells a completely different story. It's slower, steadier, and it's the number that actually reflects whether your habits are working. Someone who never looks at daily headlines but tracks their net worth quarterly and sees it creep up year over year is usually in a far better position than someone glued to daily swings and reacting to every one of them. So here's the honest caveat on all 7 of these. None of them work instantly. Paying yourself first, avoiding lifestyle creep, capturing an employer match, building an emergency fund, investing broadly, killing high-interest debt, and tracking net worth quarterly. These are slow, unglamorous, and they take years to show their full effect. There's no habit on this list that turns a modest income into wealth in a few months. What they actually do is stack quietly in the background while you're living your normal life. The person who does all 7 for 15 years and the person who does none of them for 15 years, starting from the same paycheck, end up in dramatically different places. Not because one of them got lucky, but because one of them let time and consistency do the work. To recap quickly, automate your savings so the decision is made for you. Let your savings rate rise faster than your spending when you get a raise. Grab the full employer match, it's free money. Build a real emergency fund and leave it alone. Favor low-cost, broad investments over trying to pick winners. Pay off high-interest debt before anything else, and track your net worth, not the daily headlines. If this was useful, consider subscribing, because next week we're digging into the emergency fund specifically. How big should it actually be? Where should it live? And what counts as a real emergency versus just an inconvenience? That's a topic a lot of people get wrong in both directions. This video is for general education only and is not financial advice.